Hello, everyone. Gina here with your August 5th weekly market update. Last week was a bit of a roller coaster in the market. We ended with a sharp sell-off on Friday before bouncing back this Monday. Few things that triggered that drop, but mostly was due to the jobs report that came out. To summarize, what was in there was basically July's employment data showed slower job growth and a rise in unemployment. So, why did this impact the market? Well, what happened is this jobs report really increased the likelihood that the Fed will cut interest rates in September. This, as a matter of fact, likelihood went from roughly 38% they were going to do that already in September to 90% as of the close of business on Friday. So, huge jump. And so, since there was now belief that interest rates will be lowered and bond market rates were already drifting down, the market got spooked because that indicates that the economy is slowing, aka fear of recession continues. However, on the positive side, the increase in likelihood of the interest rates being lowered is good for the stock market, which is what helped the rally come Monday. Because remember, lower interest rates means that people are going to spend more. It's less expensive for them to put money on credit cards, etc. People spending more is good for corporate profits, which increases stock prices. But all of that ties into what is certainly selling in the media recently and what many people are talking about, which is the speculation that we are due for a major correction in the market. So that's what I'm going to talk about. What's interesting is that we're really seeing the development of two markets and two types of investors. There is the Robinhood younger generation that are running up a lot of stocks, but they don't really have the buying power. As they start to earn more and that generation reaches their peak earning, we'll start to see that shift. But right now, that's very different from the flip side, which is the more affluent, less young investor who is actually still harboring a lot of negative sentiment on the stock market and has not bought into the rally. As a matter of fact, they still have about $7 trillion sitting on the sideline that moved out of equities. There have been many investors and money managers that missed out on last quarter's rally, and they still have now that major fear of missing out, and all 7 trillion of those dollars has to get back into the market, which is good for those who are already in the market. And so, do we believe we are ahead of ourselves on earnings and overbought and headed for a major recession? No. That being said, of course, we know and anticipate there's going to be a healthy pullback coming. Why do I say normal? Because believe it or not, a 5% correction in the market happens quite frequently. Even a 10% correction in the market happens roughly every year. Of course, it's our job to keep an open mind to that, and we will, of course, continue to keep you informed on our interpretation of all the fundamentals and technicals, as well as noise versus news, as we navigate through what will likely be the next couple months of some market volatility. As always, if you have questions, don't hesitate to reach out. But other than that, have a wonderful week, and we'll talk to you soon.